Well, good morning, Bob.
Morning, Bill.
We are in April and we're talking about lots of things. We're talking about unemployment, we're talking about the financial system. There's an interesting blog that you've come across and you want to tell us about it?
Well, in the Wall Street Journal, they posted a blog.
Your second favorite newspaper.
Yeah. It was actually in a number of them, a number of different newspapers, but Oliver Blanchard, who is the chief economist for the IMF, was giving a talk at the London School of Economics in honor of somebody at the Bank of England. But he basically identified 5 things that he felt economists should learn from the financial crisis.
I like the first one the best.
Well,
which is something, it's like a new word. It's a new word for economists, isn't it?
Well, he suggests that humility is in order.
Exactly. That's like a new word.
Well, you know, it's funny coming from him because he was one of the ones that fought, you know, the perception of really what's going on for a while. In his defense, he's come around, you know, but unlike a lot of the economists at the Wall Street Journal.
So humility being in order is like saying, I was wrong.
Well, yeah, that, you know, that they needed to learn from what was going on. What was frustrating to me is that there were a number of very reputable economists who had very believable models early on in the financial crisis that were pointing out the problems. And a lot of economists said, well, we know better, you know, we know that our models can't be wrong, and they just went plowing ahead.
Well, one of the flaws, one of the big inputs into their model had to do with housing prices. And since the 30s, housing prices, until we got to 07,
Right.
08, had not gone down.
Hadn't gone down, and there had been no big financial crises in the banking industry. We had a little blip with the savings and loans, but that was taken care of, and there really hasn't been anything.
In fact, if you look at the savings and loan crisis, it was not owner-occupied 1 to 4 that caused the problems.
No.
It was acquisition and development loans,
Right.
commercial property,
Right.
but not owner-occupied residential real estate.
Right, and anyway, they hit that big time, and he's saying, okay, well, maybe we need to be a little bit more humble. But in my opinion, they also need to pay more attention to the research and the writings of people who are, you know, seriously investigating these types of things.
Well, that's true, and then we had all of this shadow banking, and we had all of this shadow system, and so let's move and talk about his second point.
Well, the second point is that financial institutions matter a lot.
A lot. I mean, if you want, okay, let's step back and look at their role in the economy. All right. And you have taught this in economics, and I've taught it in the finance courses, the banking courses. A financial institution does several things. One of the things they do is they bring savers together with borrowers.
Right.
All right. Savers aggregate their money, and borrowers come. And a bank also serves as a credit vetter, if you will. They vet the credit worthiness of firms and individuals, and that's a very valuable thing. Now, some of that has been attempted to be replaced by some of the venture capital and some of the private equity firms.
Right.
However, banks do a great job of vetting the credit, and credit availability in capital formation are big components of growth.
Well, one of the things he doesn't mention, but is one of those great truths.
Well, he only had a limited amount of time to speak, so he had to get his points in.
Is that all systems at some point have problems. They go out of bounds. Okay, they all do, and so you have to have some controls to detect when things are going out of bounds and to fix it.
Well, and Greenspan, really, on the Greenspan watch, you had this concept of the Fed put, right?
Right. I mean, he basically didn't believe any of this. He thought everything was good, everything, you know, and a lot of economists, not just Greenspan, felt that, you know, that banks are no longer going to go out of, the system is no longer going to go outside the bounds.
It'll be self-regulating.
Self-regulating, it will be a totally contained system.
For our listeners out there, the Greenspan put is this concept that you can take risks your deposits are insured, and if you blow up, the government will come in and take care of you.
Yeah.
In essence, you can put your losses to the Fed.
Which basically induces excessive risk. Right?
At least theoretically anyway, and probably practically too.
Yeah, well, we saw some of it. And so that's, that was a major problem. And people have to understand that. There was a feeling that since it was all self-regulating, since we would no longer have any trouble with the financial markets, we really didn't need any regulation.
Just let's take our hands off and let's watch what goes on.
Right.
And the market will take care of it.
The system just went totally outside of the bounds. It went berserk.
It did in certain sectors.
Yeah.
And so we sort of got off the rails. Well, he made a third point.
That interconnectedness is important.
Oh my, that's a new deal.
Yeah, I mean, what we discovered, or what people involved in that, Paulson in particular, discovered was that the capital that's shown on one person's book might be heavily dependent upon the capital shown on another person's book.
Well, and it's true for firms, it's also true for governments.
Right.
If we go back and we look at the Lehman transaction, before Lehman failed, Paulson thought he had a deal to sell Lehman to Barclays.
Right.
But he had to get it approved by the British banking regulator, or regulatory authority, and he couldn't do it. They wouldn't sign off on it. And he just presumed they would.
Right.
And so that was, at least if you read the press, we weren't there, we weren't privy to the negotiations, but certainly if you read the press. And so that interconnectedness matters on a government level, it matters on a firm level.
Right.
Lehman had all these counterparty arrangements.
And you certainly have seen this in the Euro market recently with Cyprus and Greece and now Portugal. It's just all of these things are connected. Internally, we had the issue with AIG and all of the insurance that they were writing on some of these loans, which was then passed on to other lenders, which was then traded over to other lenders, and it was all...
That's why the government had to step in and bail out AIG.
Exactly. Yeah.
So, but in the interest of time, let's move on to our fourth concept.
Well, there's this issue, this concept called macro-prudential tools.
Oh, it's not traditional, just macro economics. It's more fine-tuned than that.
Right. I mean, the idea here is that let's say that you want the interest rate not to be impacted in a particular way.
So you want to do a certain sector, but not impact an interest rate.
Exactly. You want interest rates to stay fairly stable, but you want to change the behavior of one sector.
Right.
Okay. So you change some of the rules.
Maybe lower the down payment.
Lower the down payment, or change the loan to value ratio, that's acceptable, or just put in a variety of other constraints that you might do that would target a specific industry.
It's like a very targeted approach to getting that industry back up and on its feet.
And basically what he says is we don't know how well they work.
No, we're just guessing.
And
I mean that's like hard for an economist to swallow, but we're just guessing.
The guess at it, yeah, I mean it is. It's they don't really know. They don't have good models of how that works. Because what happens is that the economy is very complex.
Right.
And so if you put a constraint here, what happens is that there are ways to get around almost all.
And there are unintended consequences that we don't know sometimes.
And so you don't know about that very well.
Tell us about the last one.
The last one is that the central bank independence wasn't designed for what central banks are now asked to do.
Well, they fought long and hard. Central banks around the world have fought long and hard to be independent.
And they've got generally independence in most civilized countries, or countries where there's a strong economy. They're pretty much independent.
Now they need to act in concert many times with the governments. And they want to be independent, but they need to act in concert because they typically affect monetary policy, and the governments affect fiscal policy.
Right, and it's not just that either, because I mean, when central banks were first developed, the idea was in terms of maintaining some control over inflation. Inflation was the big bugaboo that everybody was worried about. However, central banks have gone way beyond that.
Yes,
all right,
they've had to.
They've had to. The expectation now is that the central bank is going to maintain a consistently growing economy without the normal business cycles that you would typically expect.
So as the cycle goes up and strong, they damper it. As the cycle's headed down, they try to damper that as well.
And yeah, and so the idea is that they maintain a constantly growing, stable economy. Well, that's pretty tough to do. And because they are using tools like the ones we just talked about that are specific to a particular market, there are political implications of that.
There are, and it's hard to fine-tune that.
Right, and so if they're independent, do you want to have them have that independence without the political oversight? That's a big question, and you know, there's a lot to be said for the independence. On the other hand, you know, only if they're always doing what's right.
Exactly. Which every politician wants the interest rate to be zero.
Exactly.
Well, we're out of time. This is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic week.